Stop what you're doing if you own Intel stock, or hey, if you're even just thinking about buying the dip right now, you absolutely need to see this fundamental valuation breakdown. Listen, last week I ran Intel's underlying data through 5 different valuation models and 2 legendary investing checklists, specifically Warren Buffett's and Peter Lynch's, and honestly, what I found completely shocked me. The headlines out there are screaming that the sky is falling, but I'm going to start with a highly contrarian statement. Intel's current collapse might actually be the greatest contrarian turnaround play of the entire decade. We're talking about the literal company that built Silicon Valley, now trading at levels that have Wall Street entirely polarized.
And, well, it's pretty easy to see why the market is panicking right now. Negative $4.28 billion. Yeah, Intel just posted a brutal $4.2 billion net loss in a single quarter. It's a staggering, really surprising statistic for a company with this kind of historical pedigree. Look, I completely acknowledge the pain here. Catching a falling knife is probably the single biggest fear for any retail investor. Watching a legacy blue-chip stock hemorrhage cash like this, it makes you want to hit the sell button, close your laptop, and never look back. But here's the thing. This exact scenario, this completely unprecedented level of financial pain, is actually exactly what the legends of investing look for when they're hunting for massive asymmetric opportunities.
Which brings us to the ultimate crossroads, right? Are we simply watching the slow, inevitable death of a monopoly? Or is this a calculated, deep value setup? I know, it's a bold rhetorical question to ask while the market is bleeding out, but by the end of this explainer, you'll know definitively if Intel is a classic Buffett value trap or a legendary Lynch turnaround. I promise you, I'm giving you a clear, actionable framework today that you can steal to make sense of all this chaos. So let's get into it.
Okay, Section 1. The AMD market share threat. Think about the raw numbers for a second. AMD just captured a record 32.6% of the overall x86 CPU market in Q1 of 2026. That pushes Intel's share down to 67.4%. Just a year prior, Intel was sitting super comfortably at nearly 73%. This brilliantly illustrates the massive momentum shift we're seeing. AMD's unit shipments actually increased by almost 17% year over year, while Intel suffered a 10% decline, mostly due to supply constraints. Literally, this is the textbook definition of a shrinking economic moat, and it's exactly what is spooking the broader market right now.
But the pain is really concentrated where it hurts the absolute most, and that's the high-margin data center space. AMD is steadily climbing here, officially taking over a third of the server market at 33.2%. You have to understand, this is the key segment that is thriving on AI demand right now. While Intel's server shipments have been basically flat, AMD's volumes are up, and they're up strongly. In the data center world, perception is reality, and right now, AMD is definitely perceived as the relentless aggressor.
However, let's be clear, Intel isn't dead yet, not even close. They still command a massive 71.7% stronghold in the mobile market, and they actually managed to increase their desktop share to 66.8% sequentially. Plus, they are actively cruising along on their cutting-edge 18A node roadmap, which is highlighted by the recent Xeon 6 Plus Clearwater Forest launch. So, the foundation is cracked, sure, but the house hasn't fallen down entirely. The critical question we need to answer is whether they actually have the cash to patch that foundation.
Moving on to Section 2. Cash flow and restructuring.
And wow, this really illustrates the pain I mentioned at the very beginning. That staggering $4.2 billion net loss, it didn't just appear out of nowhere. It was driven directly by nearly $4 billion, actually $3.965 million to be exact, in sudden restructuring charges. Now, this isn't just your standard operational inefficiency. This is management taking a massive, incredibly painful write-down to completely clean house and restructure the business from the inside out.
Right now, Wall Street is treating Intel like a sinking ship, but they're really more like a massive cargo ship trying to execute a U-turn in a Category 5 hurricane. They aggressively spent $3.6 billion on property and equipment just in the last quarter alone. Why? Because they literally have to build out that 18A node to survive. They are actively sacrificing short-term profitability to ensure their long-term manufacturing relevance. It's a wildly high-stakes gamble, with billions of dollars on the line.
Which brings us to Section 3, the death of the dividend. To make matters even worse for the retail folks, as those capital expenditures absolutely skyrocketed, the shareholder rewards completely vanished. Intel halted their quarterly cash dividend entirely back in late 2024. And hey, if you're hoping for stock buybacks to maybe prop up the price, think again.
The last time Intel bought back shares was way back in the first quarter of 2021. They bought over 39 million shares for $2.4 billion back then. But today, zero dividends and zero buybacks. Absolutely every spare penny is being funneled straight into the foundries. All right, let's put this into perspective with Section 4, the Buffett moat test. Warren Buffett famously looks for simple businesses with really wide economic moats, predictable cash flows, and highly consistent shareholder returns. But when we match that up against Intel's current reality, it aggressively clashes. I mean, Intel is bleeding market share to AMD, posting multi-billion-dollar losses, and freezing all of their shareholder returns. If we're looking strictly through the rigid lens of Warren Buffett, a shrinking moat combined with massive capital expenditure requirements is basically the classic textbook definition of a value trap.
But wait, let's look at Section 5, the Lynch turnaround verdict.
Peter Lynch, on the other hand, the legendary manager of the Magellan Fund, he loves a really good turnaround story. Specifically, he looks for companies that are completely hated by the broader market, but are actually taking the bitter medicine required to fix themselves. And you know what? Intel's incredibly painful $3.9 billion restructuring charge might be the exact medicine required here. Their aggressive $3.6 billion capital expenditure into the new 18A node, plus the launch of the Xeon 6 Plus Clearwater Forest chips, those represent the exact kind of hidden assets and new technology that Lynch looks for right before a company regains its dominance. So, now that you have the framework and all the hard fundamental data laid out, I really want to know what you think. We've seen the brutal $4.2 billion loss, the shrinking market share gap with AMD, but we've also seen the massive forward-looking investments in future tech. So is Intel ultimately destined to sink as a Buffett value trap, or are we looking at the absolute greatest contrarian Lynch turnaround setup of the decade? That's the billion-dollar question. Let me know your thesis, and I'll see you in the next explainer.